have a distinguished panel comprising three different viewpoints and backgrounds. Matthew Stalabras gives us the auditors and accountants and advisors view. He's a partner in Crowe Clark Whitehill's corporate team, and he works with a range of clients, both full market and also AIM clients. So there's a lot of experience in helping them to create good reporting, and he'll be actually presenting his thoughts to us in a few minutes on what makes for good reporting. Andy Brough is well known in the small and mid-cap markets and indeed the stock exchange as a whole as one of the leading investors and managers of small company funds. He's the co-head of the Pan-European small and mid-cap team at Schroders, and he has been in investment markets for something like, I think, 25 years now, and he'll be giving us his views on this subject as a fund manager. And Patricia McConnell will give us the standard setter's view as one of the people who actually sets the rules that we have to comply with. She comes from a Wall Street background, also was an analyst herself, so used to using company accounts and interpreting them, and then she moved to become a member of the International Accounting Standards Board, on its main board, as well as on a number of the key committees and responsible for setting standards. So please, I'm glad to welcome our speakers, and I'm now going to ask Matthew to kick off the discussion with a presentation.
Good morning, everybody. The last few years has seen a seemingly unstoppable trend for annual reports and accounts to get longer and longer. One analysis said that for 2010 year ends, the average length of report for a FTSE 350 company was 135 pages, with some companies weighing in at a book length 300 pages plus. There are a number of reasons behind this particular trend for reports and accounts to get longer and longer, and I'll highlight just three of them. Firstly, a regulatory reason. More and more disclosure requirements coming from the IASB, a fear amongst companies of review by the Financial Reporting Review Panel. Secondly, I think us auditors have to put up our hands and take a little bit of the blame as well. Audit disclosure checklists with yes, no answers often result in challenges where disclosures are excluded, but rarely result in challenges to companies on whether disclosures that are immaterial could be taken out. And finally, preparers of financial statements also have to recognise their responsibility as well. Too often the starting point for the next year's set of report and accounts is the agreed position from last year, which again makes it very easy to include new disclosures, but difficult to take them out. But does this trend for reporting getting longer and longer, and the danger that material information is clouded in immaterial clutter, actually matter? Well, I would say yes, reporting does matter, for two principal reasons. Firstly, reporting provides the key annual communication for directors to demonstrate to their investors and to other stakeholders their stewardship of the business. If the shareholder spring has taught us anything, it is the importance for directors to communicate clearly on matters that are important to shareholders, whether that be about remuneration or anything else. But secondly, reporting remains important because an annual report and accounts is still the first port of call for people wishing to find out information about companies, whether that be investors, potential customers, suppliers, or employees. For small and mid-cap companies seeking to distinguish themselves from their larger peers, attract new customers, the best talent, or investors, a good quality set of annual reports and accounts is worth its weight in gold. But what actually makes for a good set of reports and accounts? The first thing to say is that there is no magic formula. One of the questions as an audit partner I'm often asked by companies when discussing disclosure or reporting is, do you have an example of that? Which is actually coded language for, can I copy somebody else's? A good set of report and accounts is specific to the individual circumstances of a company and provides insight into how that company is run and the challenges that it faces. But a good set of report and accounts also focuses on 5 key factors. First of all, it should provide a reader of financial statements with an understanding of the strategy of the company and its risk management, the risks that it faces, the mitigating actions that it takes to those risks, and its attitude to those risks. Secondly, it gives a clear, a balanced and comprehensive review of the business, allowing a reader to understand the business, how it makes its money, the challenges that it's faced during that year, not just the good news, but the bad as well. Thirdly, reporting that focuses on material matters. It's very easy to hide material information in immaterial clutter. Material points should be drawn out, discussed at length, and immaterial points discarded. And changes from the prior year should be highlighted to readers of financial statements. Fourthly, we should not forget that financial reporting should be true and fair, should comply with relevant IFRS and other requirements. And finally, and perhaps one of the most important, a good set of report and accounts should be consistent, show a consistent message from front to back. When talking about what makes a good set of report and accounts, it is important to highlight to you a number of changes that are coming. And whilst I won't talk these through in detail, I will just highlight them to you. There is a current consultation issued by BIS, the Department of Business Innovation and Skills, looking at company reporting, that proposes splitting it into 2 different elements: a shorter, more focused strategic report and a more detailed annual director's statement. Personally, I welcome this. I think a shorter, more focused strategic report could help companies focus on those key factors that I mentioned earlier. But also I think this might point to a direction that financial reporting takes over the next few years, with more use of information being put online. Finally, there are some changes coming from the International Accounting Standards Board that we, again, should not forget. Projects on revenue recognition and leases will change disclosure requirements and may well have material impacts on numbers reported in financial statements. And it would be wrong not to highlight these to you. What I would like to see from the IASB as they finalise their agenda for the next few years is for actually a period of calm in financial reporting, to let companies continue to get to grips with new standards coming out that have recently been issued by the IASB, and actually focus on how they can improve their reporting as opposed to getting to grips with further standards. I would welcome suggestions that the IASB is going to look at a disclosure framework, perhaps considering IFRS in its totality and asking whether the volume of disclosures provides users of the accounts with the information that they need. And I would particularly welcome the IASB looking at a project on simplification, thinking small and mid-cap first as opposed to last, and perhaps recognising some of the different needs of the sector. It's easy to identify a trend in financial reporting for it to get longer. And it's easy to look for external sources of help in improving the situation, whether that be BIS through some of its proposals on narrative reporting, or asking the International Accounting Standards Board to make changes to existing standards. But the real challenge, I think, is for preparers, and I accept for their auditors as well, to work within the existing framework, to focus on material information and to cut the clutter, to look at the principles of good financial reporting, and above all, to plan and discuss in advance as opposed to in an often congested financial reporting timetable. For I truly believe that shorter reporting can also be better quality.